That emoji, you ever used that one before? It's this mind-blowing when you're just amazed by something, like something's happening and you're like, wow, this is actually happening, right? That's the stock market right now. It's treating basically every stock in the market like it's a little penny stock at this point in time. Tesla stock down over 7.5 percentage points here today. Absolutely brutal day for Tesla, and it's not just Tesla. Nvidia down about 5 percentage points here today. Meta down over 4%. Netflix down huge. Pretty much every single big tech was down substantially here today, right? Then you have stocks like Honest was up nearly 8 percentage points here today. Keep in mind, around 8% is what you can expect from the S&P 500, or as far as returns over a given year, right? And the fact that some of these stocks are moving that much in a day speaks volumes about where this market's at right now. Revolve up 7.7% here today. That stock's done a whole lot of nothing over the past year, but massive day today. Elf Beauty up about 5% here today. Even Fubo, it's illegal for that stock to go up. It's illegal. And even that stock was up nearly 6% here today, right? SoFi, oh my gosh. Do you know what has to happen in the market for SoFi stock to go up? You got to be flipping my flapjacks. Even SoFi was up 3 percentage points here today. The little super small market cap, the Planet, was up 11.11% here today. Meanwhile, you got the airlines down and down and down. Delta down about 4% here today. American Airlines down about 4%. United Airlines down 3.2%. Airbnb down almost 4% here today. Then you have home builders making this extraordinary move here today. KB Home stock was up over 10 percentage points here today. It's at 53% return over the past year. Toll Brothers, 7.2 percentage points up here today. Incredible move. DR Horton's up over 7% today. Lennar's up over 7% today. Pulte Home up 6.2% today. What? And then you have stocks like Lululemon. Where's the bounce? Up 0.4%? 0.4%? Estee Lauder? Say it louder. The stock's going under 100, baby. It wasn't even up. It was down 0.65%. Even today, could not push Estee Lauder up, right? Another 5-year low for that stock. So here's what we're going to do in this video. I'm going to make sense of this mess. And boy, do we have a mess in the market right now. I'm going to make sense of this mess, why this is happening, what's going on here. We're going to talk about what the market is preparing for next. I think it's always my job to get you guys ready for the next thing that's going to happen, right? And the third thing we're talking about is, does this signal a big tech being done for a while? When I say a while, I'm talking anywhere from the next 3 to 9 months. Is this kind of like a nail in the coffin for big tech in the short term here? So we'll speak about that in this video as always. Appreciate y'all joining me as always. Thanks so much for being here. And as the sign says in my garage right there, make sure you hit that subscribe button if you're not already and smash the like button. Tomorrow, I will be buying stocks in the Patreon portfolio. If you want to see the stocks I'm buying and selling each week, then you can join there. I'll put that as a pinned comment down there here today, okay? And with this tier here, you also get access to the Discord chat that's in that. That's not my private group Discord chat. That's not the 6, 7, 8-figure Discord chat. That's a smaller Discord chat with a lot of folks that have 4 figures, 5 figures in stocks. If you're a big baller, you belong to my private group, okay? If you're on the come up right now, that Discord chat's phenomenal for you. And when you also get your 5-figure award in the mail. We also have an additional tier, which is this tier comes when I become master of the stock market course. But if you're more into the high level stuff, probably just apply for my private group. That's always linked in the description down there. And also, if you pay annually, you get 16% off. Hey, that's not too bad, right? Alrighty, guys, let's get into this. So, first place I want to start here is inflation. Now, I have this here, and the reason I have that here is the market took inflation as a victory today. But we got to look a little deeper at the numbers. Do we declare victory right now, right? So, I thought we'd look at just like food, for instance, to start here. Can we really declare victory, right? And I looked at what are the things that people pretty much buy like every single week, right? And I thought eggs is something. Eggs is up 10% still year over year, right? Uncooked beef roast up 10%. Bacon, you gotta have the bacon, baby. 8.2% up year over year. I just thought this was funny. Frankfurters. Come on, man. Butter, 6.9%. Now, keep in mind, wages have gone up, 3-4% percent or so over the past year. So all these kind of core items are outstripping. Basically, if your wages went up 4% in the past year, you're losing to eggs, you're losing to beef, you're losing to bacon, you're losing to butter, right? You're losing to sugar. Sugar's up 4.8% in the past year. Fats and oils up 4%. So we got still issues with a lot of food-related items out there, right? Now, additionally, everybody's got to pay for electricity. Electricity up 4.4%. So if you're not making at least 4.4% more from your job or your business this year, let's be very crystal clear, you're losing to electricity, right? Motor vehicle insurance is out of control, is going to continue to be out of control for the remainder of this year. This is something I told you guys was going to happen months ago. Sure enough, it's happened. Motor vehicle insurance up 19.5%. You got to be flipping my flapjacks on a year-over-year basis. Come on, man. 20%? It's out of control, right? Sporting events, I'll come back to that because I just thought that was interesting. 15% up year over year. Care of invalids and elderly care at home, which is actually becoming more and more substantial and will become much more substantial over the next 10, 20 years, up 11.4%. SIGs, like, dude, I hope there's no one watching this that you enjoy SIGs, okay? Because not only is it bad for your health, but look at that. Up about 9% year over year. You gotta be flipping my flapjacks. Hospital and related services, just pray you don't have to go to the hospital, man. Oh my gosh. Motor vehicle repair up about 6.7%, right? And keep in mind, most people still drive internal combustion engine vehicles. Those have problems all the time. And so that's not good. Veterinary services up 6.4%, which, we talked about in yesterday's video. I think it was either the Reaction channel or this channel. I was talking about how these, basically the places that take in animals if you don't want animals anymore, right? There are the shelters, I guess we can call them, right? The animal shelters are overloaded with pets right now. And part of the reason is the food cost has gone up massively over the past few years and people have been hit by inflation. Another is veterinary services. I mean, that's sky high, right? And remember I talked about sporting events? I'm like, how long until people just decide not to go to these sporting events? Because I'm like, the price is insane. I was looking here to go to the Panthers game, which is the first game that the Raiders are playing at home. The cheapest tickets I could find are $178. That's before parking, that's before a bunch of other additional fees and all the other stuff that goes along with it. To watch two of the worst teams in the NFL play each other? For the worst tickets, $178. I was looking at the Browns versus the Raiders, $260. The Steelers, not even a good team, against the Raiders, $366. The cheapest tickets. I'm like, I'm amazed that people still go to these games because I'm just like, the pricing is shocking. I mean, imagine taking a family of four to a nosebleed football game. You're looking at $100. Yeah, maybe you wish. You're looking at like $1,000. You'd be kidding me, right? That's insane. So, anyways, the moral of the story is the market took today as a victory, right? Clear as day, the market believes inflation's done. We won. And Fed's going lower from here, right? And this is one of the most insane rotations on a day you'll ever see. The NASDAQ was down about 2 percentage points, while the Russell was up over 3.5 percentage points. So the divergence there between the NASDAQ and the Russell is about 5.5 percentage points, folks. That's insane rotation. Absolutely insane rotation there. Like literally one of the craziest you'll ever see, right? Now, I'm showing you this here. I'm taking you back to 2021, and the reason being is very important to understand. The Russell Wilson, okay? The Russell Wilson in the summer of 2021, it started to sniff out a rate hike cycle coming. And the Russell actually peaked around summer of 2021. And then it's kind of just like flatlined for a little bit and then obviously started the massive move down at the end of 2021 and then into 2022, right? But it really, you could see like there was already glimpses of like something's happening here, right? Because why are all these small cap stocks, why did they stop going up, right? They all peaked, at that point in the first half of 2021. And then it was kind of like, okay, these stocks aren't going up anymore. Something's happening here, right? And the reason was the market, the Russell specifically started to sniff out. We're likely going to go through a rate hike cycle. If we go through a rate hike cycle, it usually produces a tougher economy, right? It usually creates a dynamic where it's tougher to raise capital. So all the money-losing companies, right? No one wanted a piece of those, and a lot of people still don't want a piece of those at this point in time, right? Until rates are substantially lower, right? And then you have to deal with higher interest rates if you have debt. And all those things are seen as being problems for a lot of the small cap related stocks, right? By the way, some of those are actually issues for big cap stocks as well, large caps. But the moral of the story is small caps really seen as that, right? Now, if we fast forward, we go to Q4 2023, right? The Russell bottoms, right? And it actually starts picking up from there, right? Why did it do that? Why did it bottom in Q4 2023? Well, it bottomed because the Russell was sniffing out that rates had peaked. The Russell rate there was saying rates had peaked, and the Fed, whenever their next move is, it's going to be lower, right? And I got to be honest, it was 100% accurate. Both of these situations, the Russell was 100% accurate. It was 100% in the right to start sniffing out, and all those stocks that topped in the first half of 2021, it made sense. Like, it ended up being right. It was 100% right. 100% right. Because sure enough, inflation started to come in worse and worse, right? And we know how things trended from there. It got bad, bad, bad. So the fact that small caps peaked in the first half of 2021 made perfect sense. Perfect sense, right? And the fact that small caps bottomed in Q4 2023, that made perfect sense as well. Because well, guess what? It was right. Rates did peak. And it was right. The Fed's next move was lower. It was 100% accurate in both of those situations, right? Fascinating. Really, really fascinating, right? Now, I'm taking you back to summer 2006, 2007. This is very important here. And the reason I'm taking you back there is essentially the Russell. This is a Russell Wilson we're looking at here, the Russell 2000. It had a substantial move up. It basically bottoms in summer 06 and then a substantial move up all the way to the summer of 07. And I mean, it's not a small move. You know, Russell went from about 670 there to at the peak 850 plus. That's an incredibly strong move for the Russell there in basically one year, right? Now, if you look here, now I'm looking at showing you Fed funds rate, right? The Fed funds rate peaked in August 2006, right, at 5.25, which is just lower than where we're at right now. We're at like 5.5 right now, right? So as far as where the Fed was going, it peaked actually August 06. The Russell had already sniffed that out. If we see the Russell rate here, it actually bottoms in July of 06, right? So sniff that out. And then essentially the rates remain the same until August 2007, right? Now, if we look at our latest rate hike cycle, rates peaked as far as Fed funds right now we're talking about, right? Peaked in August 2023 and have remained flat for almost a year, right? Right now I'm recording this July 2024. And so here we are at a moment, right? We're about to go into August 2024 in a few weeks. And they're talking about, there's a lot of serious talk now that the Fed's first cut will be in September. And it's looking more and more probable that the Federal Reserve will cut in September. If it's not September, then I guess the latest case scenario at this point in time people are expecting is November. But I would say it's pretty high probability September the first cut comes, which is basically 2 months from now, right? Which will mean rates stayed in this elevated place for right about the same exact time it did prior to the great financial crisis, right? Now, keep in mind, the Russell peaks there in summer of 07 and then starts to go down from there. And I think that's very important we understand, right? So basically, when the Fed actually started to cut rates, right? When the Fed actually started to cut rates, actually it didn't mean the Russell was going to go up anymore really at that point in time. So just a little food for thought there, right? And at least in any substantial way. No, I also want to show you this. This is when the cut cycle started in tech. So if you want to think, is tech done now? Cuts are coming here very soon. Does that mean tech's done? Not necessarily. So remember when the Fed starts cutting. The Fed starts cutting August 07, right? And look what happened to big tech. Now keep in mind, all the big tech companies we respect nowadays, a lot of them weren't public companies back then, like Tesla, like Meta, right? I should have probably pulled up Amazon as well. That would have been nice. Although AWS wasn't really a tech play at that particular, Amazon wasn't really a tech play. It was just an e-commerce play because AWS hadn't really, become a big thing yet. And then NVIDIA was like a shell of its current company, so I didn't think that was a good fit. So Apple, Google, Microsoft, the big dogs, they were big, huge companies back then as well. And certainly, we know how big those companies are today, right? And look at, those stocks did tremendous, right? From basically August 2007 when the cuts came, all the way through until basically the end of 07, those stocks did tremendous. Apple's performance, 40% plus during that time. Google McDougal, 27%. Mr. Softy was around a 20% gainer. So if you think big tech can't go up once the Fed actually starts cutting, doesn't necessarily mean that. Those stocks could easily continue to go up for many, many months afterward, right? Now, to compare versus the Russell 2000, right, IWM, this is very fascinating, right? So when rate cuts actually happen, it does not mean great things for small caps, right? And it also doesn't mean tech's done, which is a lot of people are running that assumption, especially after seeing price action like today, right? They're running this assumption that, oh, big tech's done. This is, nail in the coffin for all these big tech companies, and this only means great things for the Russell. No, it doesn't. Because look, the Russell was okay for a little bit, but then the Russell started to fall substantially. It was like okay for that first month or two after the cuts, but then down, 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 down for the Russell, right? Meanwhile, look what happened. Mr. Softy, Google McDougal, Apple all did tremendous during that time. The Russell got destroyed from around the time the Fed did the first cuts to, kind of the end of '07 there. I mean, the Russell got destroyed. It was down almost 8 percentage points. Meanwhile, Microsoft's up 20%, Google's up 25% plus, and Apple's up 40% plus, right? So that's very important to keep in mind. So let's play a little hypothetical here, okay? So we could very well have small caps run for the remainder of July and into August, right? And into the September cuts. Because let's assume the Fed actually cuts in September. At some point in time during September, that's the first cut comes, right? So you could easily have smalls roll for the next few months, and you could even have smalls continue to roll for 2 to 3 months after that. So let's say, to kind of right in here or something like that, right? That's a situation you could have play out where smalls just go through a great next 4 to 5 months. And I don't think it's impossible. I think it is a pretty realistic possibility. Small caps haven't done anything for the longest time. People have been waiting for this move and waiting for this move and waiting for this rotation. And so I wouldn't bank on it in terms of like playing call options on the IWM or something like that. But if these smalls were to roll heavy for the next 3 to 5 months, I wouldn't be surprised at all, just to be honest. If you look at history, like it happens many times, right? And so then we get to maybe November or something like that, right? Assuming the first cut's in September, and maybe the smalls actually start to peak during that particular time. Now, that also means the big tech, right? Big tech could easily roll all the way into Q1, Q2, 2025, right? And then we could be in a situation that sets up where the whole market heads down kind of Q2, Q3 of 2025, right? And then what's going to happen after that? What's going to happen likely, I would say this is going to start to become a subject. It's going to become a subject for sure in 2025. I'm trying to time it out with trying to figure out exactly when it comes. My guess is it comes either in the second quarter or the third quarter of 2025. Everybody's going to start talking about the Fed's not cutting fast enough. The Fed needs to cut faster. They're not cutting fast enough, right? But meanwhile, big tech could easily roll in basically, into 25, well into 25 at that point in time, right? So that's something that could happen. Now, also keep in mind the soft landing narrative that's certainly still out there, right? Which everybody's hoping for. I mean, as a human, you should hope for the soft landing, by the way. But the soft landing is usually, it's a mirage. It's usually like when you're walking through a desert or driving through a desert and it looks like there's a big lake out there, right? And then you realize, oh, there's actually no lake there. It's just my eyes. It somehow made it look like there's a lake there, right? That's kind of soft landings. And I mean, you could look at this even into late '07, right? This was published at the very end of September 2007. U.S. economy on track for soft landing, Dallas Fed. U.S. inflation pressures are easing and the economy should manage a soft landing, the Federal Reserve of Dallas said on Wednesday. Obviously, the soft landing never came, right? We got into a very hard landing. It really started to hit in '08. And then obviously we know what things happened in '09, right? Check this out here. August 2007, the month before, the IMF and the International Monetary Fund, right, the big dogs, United States should return to potential growth rate of near 3% by mid-2008. There's a soft landing ahead for the U.S. economy. Yeah, it never came. That soft landing we all thought was going to come, I guess. It never came. It was a very hard landing, right? So this is what to keep in mind here, right? If this setup happens, it could very well play out this way where smalls roll here for a bit, then big tech rolls for a bit, and then we get the whole market to head down and the whole economy gets hit hard. Unemployment hits very heavy, all those sorts of things, right? I mean, it's scary how the setups are happening. Housing stocks running to all-time highs, banking stocks running all-time highs. Look at what happened right prior to the great financial crisis, man. The housing stocks were running all-time highs. You had, a lot of those housing stocks kind of peaked out about a year, 2 years before the recession hit, right? Is it going to be that long this time? Maybe it's a lot closer because there's not the same housing dynamic that happens this time, right? If you look at a lot of the big financials, they all peaked, shortly before the great financial crisis hit, and then we know what happened there, right? So then you got to ask yourself, okay, let's say there's not a housing crash that happens this time, right? And I think there's a good argument to be made that there won't be a housing crash this time. I think there's a good argument to be made that we could see some weakness in housing prices for the next, year or two. But I do think there's a case to be made that we won't have a housing crash. And there's a big difference between those two. In the way things are set up this time, I will say is better because the far majority of the masses are locked in at very low interest rates, like some of the lowest mortgage rates we've ever seen in history, right? And so they're set up in a really, really good position. A very small amount actually has to deal with high rates, and then an even smaller amount is on some sort of balloon type loan, right? There are some people out there that have that. Some of the people that have bought new homes over the past year or two, a lot of these home builders have been doing these things where they'll buy down your rate for the first year or two, maybe even 3 years, but then it hits. But that's a very small segment, I'll say, of the overall pie. So not to say that couldn't be a problem, but it's not as realistic as certainly what you had to deal with in the housing crisis. So in order to see a housing crash, I don't think that's as realistic this time. We could have housing problems, but there's a big difference between, weakness in the housing market and weakness in pricing and a crash, right? So, but where could problems come from? Well, there's a few places. Motor vehicle loans, it's gone pretty insane. I mean, if you look back, great financial crisis kind of time, 2010-ish, right? We're at around $700 billion in auto loans. And here recently, we're at about $1.5 trillion. It's a big number, man. It's a big dang number we're dealing with there, right? And keep in mind, in regards to those auto loans, if anybody's bought a new auto and really in the past, I would say a couple years, they've actually paid pretty dang high interest rates, some of the highest interest rates anybody's paid in the past 10, 15 years, right? Credit card debt, we were at about $600 billion 10 years ago. We're near 1.1 trillion now at this point in time when it comes to credit card debt. So certainly when it comes to auto debt, credit card debt, there is some kind of scariness there of, that could be a place where problems come from, right? Now, the reason that's a big substantial deal and to understand on a deeper level and how it can affect companies' numbers, earnings, the economy, employment, all those sorts of things, right, is I want to take you back to kind of '08 through 2013. We saw around $2 trillion of debt basically go, it went bye-bye. What happened? Why did that happen? Technically, debt levels should always go up. It's just the way it should be. Technically, you would always think, especially over a 5-year span, 10-year span, you can understand if debt levels drop for like a year or two, but 5 years? I don't know about that, right? Why would that happen? Why? Did suddenly Americans decide they didn't want to buy anything anymore? They're like, oh, we're anti-capitalism. No, forget it. We're not buying any more Starbucks Frappuccinos. Not buying any more Jordans. No. I don't want a PlayStation. Don't give me any of that stuff. Is that what happened? No. Got to understand how credit works. When it comes to credit and credit scores, right, the two biggest factors by far is how much do you owe and your payment history, right? Now, keep in mind, credit card debt had went up substantially going into the great financial crisis. I mean, substantially, right? And it eventually reached kind of a tipping point where it felt like people had kind of maxed out in regards to credit card debt. Then the economy got very bad, right? And so suddenly a lot of people lost jobs. Other businesses were affected negatively. Some people made less money. It was, a whole ugly situation to go through. And so what happened is a lot of people ended up burning their credit card companies, right? Also, you had foreclosures on homes. You had some people getting their cars taken away and repoed, all that sort of stuff, right? And so what ends up happening is once you burn your credit card company, once you get your car repoed, once you foreclose on a home, it's going to negatively affect your credit for years to go in the future. Not for months, for years. So guess what? Now when you go to try to get an auto loan, you're not getting that auto loan. Now when you go try to buy that new house, you're not getting that house. Now when you try to take out a credit card with a $5,000 max on it. You can't even take out a credit card, never mind a $5,000 max, right? And you basically got to start all over again with building your credit from very small numbers and hope somebody like a Capital One takes a chance on you and maybe gives you a $500 credit card. And then you have to slowly, over years and years and years, start to bump up your credit more and more and more, right? It's a process to work through, right? And when all those credit scores go down, you can't get those loans. Then you also have a bank tightening cycle at that same exact time, right? Because the economy's bad. So, and guess who's taking all the losses? Like, there's no such thing as a free lunch, right? That's what you're taught in Econ 101. There's no such thing as a free lunch. So if Joe burns the credit card company, he's got $10,000 of credit card debt, right? Because he bought a flat screen TV and he bought this and he bought that. And all of a sudden Joe says, I can't pay you guys. I lost my job. I'm in a tough situation. And so I'm not paying. Well, credit collectors are going to try to get that money out of them. They're, sometimes they might, many times they're not. And so who takes the hit on that? Well, it's the credit card companies, right? Now, credit card company might try to sell that loan off to somebody else, but somebody's getting hit at the end of the day. Somebody's getting hit. There's no such thing at the free lunch. And many times it's multiple people. So let's say it's one of those delinquency companies. They might buy that account for a 50% discount, let's say. So let's say Joe owes, XYZ credit card company $10,000, right? Well, there's a middleman company that could come in there and they say, you know what, we'll give you $4,000 for that account. And they're going to try to still collect $10,000 from Joe, but they're going to pay the credit card company $4,000. Now, the credit card company might look at that and they say, okay, so we could limit our loss here and take a, let's call it a $6,000 loss and recoup $4,000 of this, or we can try to get this out of Joe, right? Credit card company might look at that XYZ corporation and say, you know what, let's just sell it off to ABC collectors, okay? And so then ABC collectors pays them $4,000 to the credit card company, right? And then essentially they're going to try to collect out of Joe. And if they can't collect out of Joe, boom, they just took a $4,000 loss on that, right? So there's no such thing as a free lunch. Somebody's paying for it. Somebody's paying for it. And that could obviously hit the economy very negative. If all of a sudden people can't have credit cards, if they can't buy, a car on a loan, which is how most people buy it, if they can't get a home loan, that's how an economy gets hit. That's how you get a big unemployment cycle to happen, right? And then you have kind of a cleansing of the debt market. And then as the economy gets better and better over coming years and the employment cycle gets better, debt goes up and up and up, right? It's important you understand that. Now, another factor is, if you guys watched my video yesterday, which I hope you got a chance to see that, it looks like 44,000 people have gotten to see that so far, right? We spoke about consumer stocks. And these consumer stocks, these big corporations that honestly people love to own these sorts of stocks, right? McDonald's, Starbucks, Nike, all these sorts of companies, right? They've been crashing. In generally speaking, stocks go down for a reason. They're usually not going to, especially when it's a big group and especially when it's very popular companies, it's not like it's for no reason. Like, for instance, if you talk about big tech in 22, why did those stocks go down? Their earnings tanked. Did you see what happened in NVIDIA's earnings by the end of, by the end of 2022 going into 2023? Did you see what happened to Amazon's earnings the end of 22 going into 23? Meta's earnings? Go through all those companies. Their EPS tanked. Their growth rates tanked. From basically where they were at in 2021 to where they're at the end of 2022 is disaster, right? And so it didn't at the time, but by the end of it, you're like, oh, I see why all those stocks got hit heavy. Well, their earnings tanked, right? And so all these consumer stocks getting hit one after another after another, I think a lot of people are looking at it and they're like, it doesn't really make sense why these stocks are getting hit so hard. Well, maybe these companies' earnings are going to get really bad over the next 6 to 9 months. That's a little food for thought there. If those earnings are really bad in the next 6 to 9 months, then everybody's going to be like, oh, it made sense why those stocks all fell, right? And so that's a little food for thought in regards to that. And so when it comes to all these consumer stocks, if people can't, take out credit card debt and things like that to buy stuff, it's not good. That leads us to travel. Travel's a mess. What's going on here? You hear all these stories about travel's never been higher. I believe just July 4th weekend, we had the highest amount of people flying around that we've ever had in history, from my understanding, right? And so you hear that and you think, oh, it's got to be great days for airlines. No, it's horrible. And I think one of the reasons for these stocks going down is I think a lot of people view this as demand only gets worse from here over the next 1 to 2 years. I think that's really the viewpoint. And that's scary because people look at that and they say, if it only gets worse, do we want to be in these sorts of stocks? If airline demand's only going to get worse for the next year or two, and we've peaked, or we're at a peak, people don't want to own these sorts of stocks into that. But we have a much worse problem going on. Much worse. Look at this. Delta Airlines reported their earnings this morning, right? Now, if all you looked at was revenue and you never looked at anything else, you would think things are great for Delta's business, right? The revenue was up 7%. Now, if your revenue is up 7%, then your net income should be up at least 7%, right? Minimum, if not a lot more than that. But you should not have your net income go down, especially in any substantial way. We'll look at this. They got eaten alive by expenses. Salaries and related costs up 9% year over year. So that outstripped revenue. I basically circled anything that outstripped revenue growth as far as a percent. Aircraft, fuel, and related taxes, 12% up year over year. Ancillary business and refinery up 25%. Landing fees and other rents, 24% up year over year. Aircraft maintenance materials and outside repairs up 11% year over year. Depreciation and amortization up 8% year over year. Other category, which who knows what they put into that category, right? It's actually a pretty big line item. It was up 17% year over year, so the total operating expenses up 10%. So if your total revenue is up 7% and your total operating expenses is up 10%, and especially when you're an airline and your expense items is massive, that means your profitability is going to get wrecked. And guess what happened? Operating income fell 9% for the company year over year. Net income fell 29% for the company on a year over year basis. And this is during a time period of record demand for air flights. So what happens? What happens if revenue goes down? What happens if we get an unemployment cycle? And guess what? There's just not as many people flying in 2025 as there were in 2024. Like, what is going to happen to this company? Because a lot of these expenses, it's not like they can just magically have these go down suddenly. Like, let's imagine the back half of the year, Delta's business, it just isn't as strong as a spot as far as revenue goes as it was in the first half of the year. What do you think is going to happen to their profitability then? Because it's not like these line items are going to magically move. No bueno. Now, let's talk about breaking the market. Because if you're gonna break the market, you can't just break Delta Airlines, no, or Lululemon stock. If you want to break the market, you gotta break these guys: Tesla, Apple, Amazon, Google McDougal, Meta, Nvidia, Microsoft. These guys run the market. And if you're gonna break the market, you gotta break these guys. Can you break these guys? And when I say break them, you gotta break their earnings, right? Well, Tesla. Could you break Tesla? It's a potential. I mean, let's say everybody's expecting Tesla's business to come back pretty decent back half of this year. What if it doesn't happen? Well, then you could break Tesla stock, right? Apple, I think it's a hard one to break. We know the numbers for this current quarter they're about to report in a few weeks isn't going to be good. But when it comes to Apple, guess what? They got a big iPhone coming. And it's probably going to boost up their numbers at least in September quarter, probably into the fall time quarter, or probably into the winter quarter, right? So I think Apple's a hard one to break right now, although the valuation doesn't look very compelling. Amazon, we know Amazon Web Services is going to show good growth. We know the e-commerce business continues to take share. I think it's hard to break Amazon, although it's possible. I think it's hard. Google McDougal, that's another one that's hard to break. Actually, relatively low forward PE on that stock. Meta, same exact situation. I think Meta is really hard to break, at least in the short term. When I say break, I'm talking really over the next couple quarters. Nvidia is going to come through with banger numbers. Next quarter's guide is going to be great. 2025's year numbers are going to be great. So Nvidia is pretty safe for now, right? I don't know if it's safe, for the next 3 years, but for at least the next 3 months, 6 months, we're looking pretty good there. Mr. Softy, same exact deal. So I think it's hard to break the market because I think it's hard to break these stocks' earnings. And that's an important thing to kind of keep in mind here. Now, something that I think is very important is, look at this article here today out of Fortune. After a surge in Rona profits, Rolex, Patek, and AP face significant downturn as sales slip, extending a 2-year decline. My question is, the high-end consumer has been supposedly spending out there top 10 to 15%. What happens to the economy if those people pull back? What happens if the stock market was to get hit? Real estate prices got hit 5-10% in most markets. is the top income earners, are they going to still be spending like that? I don't know. That's going to be interesting to see how that plays out, right? Now, at the end of the day, despite all this, hunt for deals. Hunt for deals, folks, okay? I'm going to be hunting for deals regardless of the economy, what the Fed's going to do, who's going to be the next president, any of that stuff, okay? And the way I'll put it to you like this, do you think any of these guys are making their judgments based upon what the Fed's doing, based upon what the president's going to be or not be, based upon what's going to happen in the economy? Of course not. Warren Buffett's thinking about companies for the next 5, 10, 30, 50 years, okay? When Jeff Bezos was running Amazon, he wasn't like, oh boy, we better not launch this product. We better not do this because, the Fed might do this. No, okay? You think Jensen's out there like, oh man, the Fed's going to cut. That means it's great for business. Let's go hire an additional 20% of employees. No, like no one that's a great businessman or woman or investor is actually going to make any judgment calls off of all this. It's important to look at. I guarantee you all these guys look at that sort of stuff, but when making your decisions, everything always needs to have a long-term focus behind it, because we do know all this other stuff changes. The economy, weak, strong, okay, it's all going to change a year from now, 2 years from now. The Fed, all going to change. The president, always going to change. So all this stuff ends up changing. The long term is what matters in the end. And that's why tomorrow I'll be buying stocks out there. Same thing with the following week. Same thing for the following week. I'm buying companies that I believe have great futures, are going to give me great returns, just as so many of my stocks have done, right? Like Meta and Tesla and Palantir and Amazon and all these sorts of companies that have produced me phenomenal returns. Elf Beauty, obviously 2,600%. That's who I'm hunting for, because the rest of that stuff's all going to change, guys. Appreciate you joining me. If you're looking to join my Patreon, pin comment down there. Get on in there. See the moves I'm making each week. Plus be part of that Discord chat and get your 5-figure award once you're over $10,000 in the market. Much love and have a great day.